I watched my best friend lose $40 million in 6 months. It still feels like yesterday. The call came at 2 in the morning. I could hear the panic in his voice before he even spoke. He said, Charlie, I don't know what to do. I've got nothing left. He wasn't exaggerating. He had destroyed himself, not through bad luck or a market crash, not through fraud or theft, but through one decision that took him from wealthy to bankrupt in half a year. And as I listened to him break down on the phone, I realized something I've seen over and over again throughout my life. This is what happens when you know how to make money, but have no idea how to keep it. I'm Charlie Munger. I'm 99 years old, and I've been wealthy for over 60 years. I can tell you with absolute certainty that getting rich is easy compared to staying rich. I've watched hundreds of people build fortunes and lose everything. Lottery winners, business owners, successful investors gone. And it's not because they were stupid. It's because they never learned the one principle that protects wealth forever. The principle that saved me through every market crash, every recession, every disaster for 6 decades. And I'll tell you this right now, if you don't learn it, you will lose everything you've built. I've seen it too many times, but I also know exactly how to make sure that never happens to you. Before we go deeper, I want you to do something. Drop a comment right now and tell me where you're watching from. Tell me what your biggest fear about money is. Are you afraid of losing what you built? Worried about the next recession? Scared you'll make one mistake that costs you everything? Be honest. There's no judgment here. And I want you to make a promise. Watch this entire video until the end. Not for me, for your own financial survival. Because what I'm about to share could save you from losing everything. The people who stay wealthy are the ones who finish what they start. They commit to learning. They don't quit halfway through. So promise yourself right now, stay until the end. Your future self will thank you. And more importantly, trust yourself. The fact that you're here means you're thinking long term. That puts you ahead of 95% of people. Trust that instinct. Now let me tell you about my friend, David. We went to law school together. Brilliant guy. Built a real estate business from nothing. By the time he was 50, he was worth $40 million, multiple properties, strong cash flow, financially free. He had it all. And then one decision changed everything. He met a business partner who had an opportunity, a real estate development deal that promised massive returns. Luxury condos in a booming area. The projections looked incredible. $50 million in profit if everything went right. David excited. He got greedy. He took out loans against his properties. He liquidated investments. He put everything into that one deal. And for a while, it looked brilliant. Construction began. Pre-sales were strong. Money was flowing, and he walked around saying he'd be worth $100 million by the end of the year. But then the market shifted. Interest rates went up. Buyers backed out. Construction costs doubled. The project stalled. And David was stuck. He had debt. He couldn't service properties he couldn't sell, a project bleeding money every single month. Within 6 months, he lost everything. The properties went into foreclosure. The project went bankrupt. His partners sued him, and he was left with nothing but debt. $40 million gone. That night at 2 in the morning, he called me completely broken. He said, Charlie, I worked 30 years to build this, and I destroyed it in 6 months. How do I come up from this? And I told him exactly what I'm going to tell you. You come back by never making that mistake again. You come back by learning the one principle that ensures you never lose everything. And that's what I'm going to teach you right now. But I need you to understand, every minute from here contains lessons that took me 70 years to learn. Don't cheat yourself by leaving early. The first principle of real wealth protection is this. Diversification isn't enough. You need anti-fragility. Let me explain, because this is the most misunderstood concept in finance. Most people think diversification means owning different things. Stocks, bonds, real estate, maybe some gold, and they believe if one goes down, the others will protect them. That's what every financial advisor says, and they're not wrong, but they're incomplete. Diversification protects you from losing everything. It doesn't protect you from losing a lot. It's defensive. It says I'll spread my risk, so no single failure destroys me. That's fine, but it's not enough, because in a true crisis, everything goes down together. In 2008, stocks crashed, real estate crashed. Diversification didn't save people. It just meant they lost money in multiple places instead of one. Anti-fragility is different. It doesn't just protect you from loss. It allows you to benefit from chaos. It means your wealth doesn't just survive disasters. It grows stronger because of them. That's the difference between those who stay rich and those who lose everything. Most wealth is fragile. When something goes wrong, it breaks. Some wealth is robust. It survives, but anti-fragile wealth thrives in volatility. It grows when things fall apart. That's the thick of wealth you need to build if you want to stay rich for life. Think about it this way. A wine glass is fragile. Drop it, and it breaks. A plastic cup is robust. Drop it, and it survives. But your immune system is anti-fragile. Anytime it's challenged, it gets stronger. Your muscles are anti-fragile. Stress them, and they grow. Your wealth can work the same way. Every crisis, every downturn, every disaster can make you stronger if you structure it correctly. That's what I'll teach you step by step. But you have to stay with me, because what you're to learn isn't theory. It's 6 decades of surviving chaos and coming out richer every single time. The first rule of anti-fragile wealth: never, under any circumstance, put yourself in a position where you can lose everything. That sounds obvious, doesn't it? But almost everyone violates it at some point in their life. David did. He took on too much leverage. He concentrated too much of his wealth in one deal. He made a bet he couldn't afford to lose. And when things went wrong, and they always do, eventually he was destroyed. Let me give you the simple math that will save your financial life. If you lose 50% of your wealth, you need 100% return just to break even. Think about that a second. If you have $1 million and you lose half, you're down to 500,000. To get back to 1 million, you need to double your money. That's 100% return. And 100% return doesn't happen often. So a 50% loss isn't just painful, it's catastrophic. It can set you back a decade. But if you never take a hit that big, you never have to waste years digging yourself out of a hole. Now the math gets even worse. If you lose 75% of your wealth, you need a 300% return to recover. Lose 90%, and you'll need 100% to get back to even. Do you see the pattern? The deeper the hole, the harder it is to climb out. That's why I've spent my entire career obsessed with one thing: avoiding catastrophic loss. Not because I'm afraid of risk. I've taken plenty of risk, but because I've never taken a risk that could destroy me completely. Every bet I've made has been survivable, and survival always comes before growth. Write that down, because if you don't survive, there is no growth. You're out of the game permanently. That's the real secret to staying rich. Never be forced out of the game. I've never had more than 25% of my net worth in any single investment, ever. Even when I was absolutely certain something would work, I capped my exposure. Why? Because I could be bored. And if I'm wrong, I lose 25%, not 100%. A 25% loss is painful. But it's survivable. A 100% loss is fatal. David went all in. He violated the rule. He put 100% into one deal. If he had just limited himself to 25%, he would have lost 10 million painful this, but he'd still have 30 million left. He could have recovered, learned from it, and moved on. But when you go all in, you have no recovery. You're finished. So write this down. Never concentrate more than 25% of your wealth in a single investment. No matter how good it looks, no matter how certain you are, no matter how much you believe in it, that one rule will save you from 90% of the wealth-destroying decisions people make. Now, let's talk about why people break this rule. Because understanding the psychology behind failure is as important as the rule itself. People go all in because they want to get rich fast. They see an opportunity and think, if I just put everything in, I'll make a fortune. And sometimes it works. Sometimes people bet everything and win. But here's the truth. For every one person who bets it all and wins, There are 99 who bet it all and lose. You just don't hear about them. They disappear quietly. You don't see them on magazine covers or YouTube interviews. They're not giving speeches about their success. They're sitting in silence, trying to rebuild their lives. That's survivor bias. You only see the winners, not the graveyard of losers who made the same bet. And when you only see the winners, you start to think maybe you can be the exception. But odds are you won't be. And even if you were, is it worth risking everything? The second rule of anti-fragile wealth, always have optionality. Optionality means you always have choices. You're never forced into a bad decision. You're never desperate. You can wait for the right opportunity. Most people lose money because they lose their options. They corner themselves. They take on so much debt or commit so much capital or stretch their resources so thin that they can't walk away. They can't wait. They can't breathe. That's what happened to David. When his project started failing, he had no options. He couldn't stop. He couldn't pause. He couldn't pivot. He was locked into a deal that was bleeding him dry, and the only choice he had was to keep throwing money at it. He was forced to take on more debt, forced to sell good assets at terrible prices, forced to make bad decisions, all because he had no slack in his system. No optionality. You build optionality by always having more resources than you're currently using. Cash, you're not spending. Credit, you're not borrowing. Time, you're not committed. Space to breathe. Flexibility to say no. That's where real power comes from. The ability to wait. Most people run their lives and their finances at maximum capacity. They invest every dollar. They borrow as much as they can. They commit all their time. And they think this is efficient, that this is what smart people do. Why let money sit idle, they say? Why keep credit unused? Why not make every dollar work? Because that kind of efficiency kills resilience. When you're running at 100% capacity, any disruption, any unexpected event breaks the system. You're one bad month away from collapse. That's why I always keep at least 20% of my net worth in cash or extremely liquid assets. Always. No exceptions. Even when the market looks unstoppable, even when I feel confident, I keep that liquidity. Why? Because that 20% gives me power. It gives me the ability to wait. When everyone else is panicking, I'm calm. When everyone else is selling, I'm buying. When everyone else is desperate, I'm strategic. Yes, that cash underperforms during good times. It loses a bit to inflation, but in a crisis, it becomes a weapon. Because the person with cash, when others are desperate, can buy assets at 50 cents on the dollar. They can negotiate from strength. They can seize opportunities while everyone else is drowning. That's anti-fragility in action. David had zero liquidity. Everything was tied up. So when he needed cash, he was forced to borrow at terrible terms. And when he couldn't service the debt, he had to sell assets at fire sale prices. If he'd just kept that 20%, $8 million in cash, he could have survived. He could have waited out the downturn, but he didn't. And that's why he lost it all. This is how the wealthy stay wealthy, not by being the smartest or the luckiest, but by always keeping options open, by never betting the farm, by always living to fight another day. The third rule of anti-fragile wealth, build income streams that don't depend on your time. This one sounds simple, but it's the dividing line between the rich who stay rich and the rich who quietly fall apart. You see, most people think wealth is about net worth, how much money they're worth on paper, but that number means nothing if your lifestyle depends on constant effort. What keeps you rich isn't your balance sheet, it's your cash flow. And not just any cash flow, passive cash flow, the kind that keeps coming in even when you're asleep, even when you're sick, even when the world is falling apart. Because if your income stops the moment you stop working, you're not wealthy, you're just well paid. And well paid is fragile. It's one bad quarter away from panic. It's one ONS away from collapse. It's one market shift away from disaster. And that's not freedom, that's a treadmill. the most dangerous treadmill there is because it tricks you into thinking you're secure when you're not. I've seen countless high earners trapped this way. They make $500,000 million a year, and they think they're rich. But all of it depends on constant work, constant deals, constant pressure. They don't own their time. Their income owns them. And when the treadmill stops, when they lose energy, when their industry changes, when something unexpected happens, everything they've built crumbles overnight. David was exactly like that. Every dollar he made came from active deals. He had to keep developing, negotiating, managing projects. When the market froze, his income froze. When income stopped, but expenses continued, that's when the collapse became inevitable. If he'd built income streams that didn't rely on his time, rental properties, dividend stocks, bonds, royalties, ownership in businesses that others ran, he would have had cash flow even as his active projects. That cash flow could have bought him time. It could have covered his living costs, serviced some of his debt, given him room to think, but he had none. When active income stopped, his entire system fell apart within months. Here's the rule. Your goal isn't just to build wealth, it's to build wealth that produces income. Every asset you own should have the potential to pay you, not just make you look rich, because assets that produce nothing are fragile. They rely on appreciation, and appreciation is just another word for hope. And hope isn't the financial strategy. So every time you consider an investment, ask one question. Does this put money in my pocket without my time? If the answer is yes, that's an asset. If the answer is no, that's a speculation. You can speculate a little, 10%, maybe 15% of your portfolio, but the foundation must be cash flowing, productive assets, real estate that rents, stocks that pay dividends, bonds that pay interest, businesses that generate profit, whether you're working or not. And here's the mindset shift that most people never make. I care more about the income my investments produce than I do about their market value. If I own a stock that pays me $50,000 per year in dividends and the market drops 30%, have I really lost anything? Not if I'm not selling, my income hasn't changed. That loss is just a temporary number on a screen. But if the dividend keeps coming, I'm fine. In fact, better than fine, because if the stock is cheaper, I can buy more shares and increase my income. That's anti-fragility. The event that destroys fragile investors, volatility, actually benefits me because I'm not dependent on price, I'm dependent on cash flow, and as long as money keeps flowing in, I can hold through any storm. Now let's talk about the fourth rule. Assume you're wrong about everything. This one's hard. It goes against every instinct we have as human beings. We all want to believe we're smart, that we've done the research, that we found the right answer. David thought that way. He believed his projections. He believed his partner. He believed he was right. And when he wasn't, he lost everything. That's the danger of certainty. It blinds you to reality. Certainty makes you arrogant. It makes you concentrate too much, leverage too much, ignore the possibility of failure. And when you build a financial life around being right, you only have to be wrong once to lose it all. The wealthy who stay wealthy think differently. They build their entire structure assuming they're wrong about everything. That way, even when they're wrong, and they're wrong often, it doesn't matter. Their mistakes are survivable. So what does assuming you're wrong look like in practice? It means you never bet everything on one prediction. You never assume the market will keep going up. You never assume interest rates will stay low. You never assume your job, your business, your health, or your country will remain stable. You plan for multiple scenarios: inflation, deflation, booms, busts, prosperity, and crisis, and you position yourself so that no single event can ruin you. That's why my portfolio is always diversified across realities. I own assets that do well during inflation, like real estate and certain stocks. I own assets that do well during deflation, like cash and bonds. I own assets that thrive when the market booms, and assets that hold value when it crashes. No matter what happens, some part of my portfolio wins, and the parts that lose, they're small enough not to matter. That's the essence of anti-fragile wealth. Your survival doesn't depend on being right. It depends on never being catastrophically wrong. Most people don't build that way. They build based on prediction. I know the market will rise. I know this deal will work. I know this industry will boom. And when they're wrong, they're done. But I've never pretended to know what's going to happen. I don't know if the stock market will double or crash. I don't know if interest rates will rise or fall. And that ignorance, that humility has kept me rich. You don't need to know what's coming next. You just need to build a system that survives anything. So when someone asks, Charlie, what's your secret? I tell them this: I don't try to be right. I just make sure that when I'm wrong, it doesn't matter. Now, let's move to the fifth principle of anti-fragile wealth. Prepare for disasters before they happen. Most people are reactive. They wait until something goes wrong, and then they scramble to fix it. But by then, it's too late. The damage is done. David never prepared for the worst. He didn't prepare for interest rates to rise. He didn't prepare for costs to increase or for buyers to disappear. He assumed everything would go according to plan. And when it didn't, he panicked. And panic destroys wealth faster than any market crash ever could. The people who stay rich are paranoid optimists. They hope for the best, but prepare for the worst. They spend time thinking, what could go wrong? And they build systems to survive it before it ever happens. That's what I'll teach you next, the practical side of disaster preparation. Because the truth is, it's not enough to make money. You have to make your wealth indestructible.